The factory in Hanford, California still stands, concrete and steel spanning 800,000 square feet, purchased for over $1 billion, never used to build a car at scale. The numbers are forensic. Approximately 13 FF91 vehicles delivered across the flagship model's entire production life. 4 units in all of 2025, Q1 2026 net loss $38.86 million, against revenue of just $512,000. Stock trading below $1 with active delisting risk. A founder who fled China beneath a debt crisis. An SEC investigation that ran for years. $3.2 billion consumed. 13 cars delivered. Thousands of employees, hundreds of suppliers, retail investors who bought the SPAC at peak hype, all absorbed consequences from decisions made at the top. This was never simply a startup that tried and failed. Something structural was broken from the start. But in 2014, none of this was visible. What the world saw was a Chinese billionaire with a plan to make Tesla obsolete, and enough capital to make people believe him. Jia Yueting does not arrive in the electric vehicle space as an outsider. By 2014, he is one of China's most celebrated entrepreneurs, the architect of LeEco, a conglomerate spanning streaming, hardware, and consumer electronics, whose market capitalization briefly positions him among the wealthiest technology founders in Asia. The Chinese press bestows on him a label usually reserved for Silicon Valley, the Steve Jobs of China. That credibility matters. When Jia incorporates Faraday and Future Inc. and begins recruiting engineers, he attracts serious talent. Individuals with documented experience at Tesla, BMW, and aerospace programs. The CES 2017 concept vehicle, unveiled before a global press audience, is not theater alone. The underlying architecture, a software-defined connected electric vehicle platform, is a coherent engineering thesis at a moment when the market is genuinely beginning to reward exactly that approach. Investors, suppliers, and engineers have rational reasons to believe. The EV transition is real. The founder has scaled companies rapidly. The engineering hiring is documented. The concept vehicle generates significant mainstream coverage. But embedded in the foundation is a structural fault that no press release mentions. Faraday Future is capitalized primarily through Jia Yueting's personal resources and the implied financial backing of LeEco, two entities presented as separate, drawing from the same fragile pool. By 2017, FF has secured a major factory commitment in Nevada and is being openly compared to Tesla in its founding years. Then, LeEco's balance sheet begins to fracture, and with it, everything FF has assumed about its own stability. The moment arrives with the force of institutional validation. In 2021, Faraday Future merges with Property Solutions Acquisition Corp., a special-purpose acquisition company, and becomes publicly traded on NASDAQ, bypassing the extended scrutiny that a traditional IPO underwriting process would have demanded. The SPAC route is legal, widely used in that era, and effective at routing capital to companies before they have demonstrated they deserve it. Consider what the public markets absorb at that moment. Faraday Future carries no production vehicle, no verified delivery timeline. Its founder, Jia Yueting, had already presided over the collapse of LeEco, his prior conglomerate, beneath reported debt that by 2017 exceeded $3 billion. That precedent is not obscure. It is publicly documented and traceable. The listing proceeds regardless. The stock, briefly, rewards the narrative. At its 52-week high, FFAI reaches $3.61 per share. The same share recently trades near 39 cents. What the SPAC mechanism accomplishes, structurally, is a transfer of risk from insiders and institutional participants who understood the fragility to retail investors who encounter the story at the moment of peak optimism. The distance between the investor narrative, a fully capitalized, technology-advanced EV challenger with a Nevada factory site and a California production facility, and the operational reality, a company still years from a manufacturable product, is not disclosed with the clarity that distance demands. 3 months after the SPAC closes, a short seller report lands. It does not simply question the valuation. It questions whether the company was honest with investors at all. The short seller report lands with surgical precision. Its allegations cut across every layer of the company. Pre-orders misrepresented to investors, related party transactions left undisclosed, governance structures that exist on paper but dissolve under scrutiny. The SEC opens a formal investigation. It will run for years before concluding without enforcement action. But that conclusion changes nothing about what the report exposes, because at the center of Faraday Future sits a control failure that predates the listing by years. There is no functional separation between Jia Yueting's personal financial distress, Li Go's collapsed balance sheet, and FF's own capital requirements. These are not 3 distinct entities. They are 3 expressions of the same deteriorating financial pool, a single organism wearing 3 masks. And that interdependency is never disclosed to public market investors with the clarity it demands. The governance failure is even more direct. When Jia fled China in 2017, Chinese courts designated him a dishonest debtor. Travel restrictions followed. Asset freezes followed. His documented personal liabilities ran into billions of dollars. Yet none of this prevents him from retaining effective strategic control over Faraday Future, a company simultaneously raising capital from public market investors who have no visibility into that entanglement. Think about what that means structurally. The person directing the ship's course is already underwater on debts from the last ship he sank, and no one on deck is told. In 2022, FF's own special committee concludes an internal investigation. The findings confirm what external critics had alleged. Jia had pressured employees to provide false information to the board. Not rumor, not inference. The company's own investigation. He is stripped of operational authority, then reinstated. The SEC investigation dragged on. The stock collapsed. From a 52-week high of $3.61 to recent trades near 39 cents. The factory sat largely idle, and the question shifted. It was no longer whether Faraday Future could build a car. It was whether anyone at all, would be held accountable for what investors had already lost. But accountability, it turns out, requires something Faraday Future has never had enough of: a structure built to hold. The math is not ambiguous. Approximately $3.2 billion raised across the company's operational life. 13 FF91 vehicles delivered. That ratio is not a rounding error. It is the structural outcome of every decision documented before this moment. By end 2025, reported net assets stand at $7.7 million. Against cumulative funding of $3.2 billion, that figure represents a destruction of capital that no pivot language can reframe. The company's full year 2025 net loss is reported at approximately $400 million. Market capitalization sits near $117.8 million, a fraction of what was consumed building toward a product that never scaled. The human fallout follows the same arithmetic. Repeated mass layoffs across Faraday Future's workforce. Suppliers carrying unpaid invoices, generating cascading litigation. Retail investors who purchased the SPAC narrative at elevated prices absorbed losses that insiders, through early positioning, had largely avoided. FFAI stock touches a 52-week low of 266 cents. It trades near 39 cents today, with active NASDAQ delisting warnings attached. The Hanford factory stands. The Nevada site was abandoned years earlier when financing first collapsed. In 2026, Faraday Future formally abandons mass EV production as its primary business and reframes as a physical AI and embodied AI robotics company. Q1 2026 robotics revenue reaches $512,000. Net operating loss for the same quarter, $35.9 million. The ratio requires no editorial comment. The Nevada site is gone. The cars were never built. The company remains public, still raising capital, now telling an entirely different story. Jia Yueting has been reinstated as sole global CEO. The SEC investigation closed without enforcement, which raises the only question the Wreckage demands. What did the system fail to stop? And does it have the tools to stop it next time? The failure has a name. It is not Jia Yueting's alone. The SPAC structure, as deployed in 2020 and 2021, allowed a company with no delivered product, a founder under foreign court sanctions, and governance dependent on unchecked single-person authority to access public retail capital with materially less disclosure than a standard IPO demands. That is not opinion. That is the mechanism. And the mechanism worked exactly as designed, which is the problem. The post-mortem chain resolves clearly. The premise: a credible technology vision that attracted genuine talent and serious early capital. The escalation: a financing strategy that substituted narrative milestones for operational ones. The hidden fragility: the undisclosed interdependency between Jia Yueting's personal liabilities and the company's capital structure, never presented to public investors with the clarity it demanded. The trigger: LeEco's collapse. The fallout: borne disproportionately by public market participants who entered last and understood least. The people closest to the exit sign always leave first. The pattern has not resolved. In February 2026, Faraday Future raised its authorized share count to 336,372,704. A structural dilution mechanism embedded in the cap table like a slow release valve. Between April and May 2026, the company raised capital to fund Phase 1 of its robotics pivot. Q1 2026 robotics revenue, $512,000. Full year 2026 shipment target, 1,500 units. Units shipped through end of April, 68. The SEC investigation concluded without enforcement action. The system examined the wound and decided it wasn't bleeding enough to stitch. The narrative wrapper has changed from electric vehicles to embodied AI. The capital consumption rate has not. When a founder's financial distress and a company's financing needs share the same balance sheet, that is not a risk factor buried on page 47 of a prospectus. That is the business model. Every cycle produces companies that are better at raising money than spending it wisely. The question isn't whether the next one will appear, it's whether you'll recognize it before your capital is already committed. Are you funding a product, or are you funding the story of a product?